Good afternoon, everybody. Thank you very much for joining myself, Ian and Kelly here from Gravita to talk to you about what happened last Wednesday at the budget, or at least perhaps some of the stuff that didn't happen as well. There's a fair amount of that. We're going to stay away from the news today. Those of you who are on top of this, there was a bit of an argument going on about what the Chancellor should and shouldn't have said to the public at large. But we'll stay away from that because this isn't about politics. It's very much about the fiscal side of the budget, and particularly the tax elements that fell from it. So please use the Q&A bit inside I think we're using Zoom today. So you please use the Q&A, drop any questions you've got in that, and I'll keep abreast of those as they come in and ask the panel what their thoughts might be. And there's also a poll that we've launched inside the functionality of Zoom, which I think the question is, what's the most pressing, most important aspects of the budget for you? And it's tax we're looking for, it's the tax stuff, but by all means put any comments you like in there. So there's a QR code at the bottom of the screen. Please use that if you know how to use those things, and that will take you through to a sort of landing page. So you can ask us questions directly from there, and we can come back to you at a later date. And this webinar itself is being recorded and will be shared with all of you that have kindly turned up today to listen to us talk about these things. So please look out for that. So as I've introduced already, I've introduced Kelly, who's from our Southwest office of Gravita, and Ian Timms, who works in our Oxford office up there. So thank you very much, guys, for travelling all the way into London to here today. Right, so I think the first place to start is what wasn't in the budget. Ian, would you like to kick off with some thoughts?
Sure. I always tend to judge a budget on a couple of things. So number one being what wasn't in the budget. It wasn't as bad as we thought. I do wish there wasn't as much kite flying about as we probably saw, but let's think about the practicalities. CGT didn't go up, corporation tax didn't go up, we didn't get the income tax rise as we thought, we didn't get an exit tax, which was brought about all over the place before.
Yeah, that was a big one, right? That was a big one. We had clients on planes who were, the reason they did that was because they were really concerned that there would be some sort of exit tax where the government would treat you as disposing of all of your assets and re-inquiring them at market value, and whatever the difference was, if it was a gain, you pay tax.
Yeah.
20%, I think. Is that
20,
right?
I think it was 25.
25, was it?
Yeah.
Okay. Even worse. So that didn't turn up. Anything else?
That didn't turn up. It's probably worth noting that we do have an exit tax in this country for companies.
Sure.
So if you're going to move abroad and your company becomes non-resident, you might get a tax charge there. But for individuals, it's not too bad. You can still move abroad and save tax, sell your company and save tax if you stay out for 5 years. I'd probably say one of the biggest ones was wealth tax. We didn't get a wealth tax this budget. And I've seen some stories, and I read into this bit of wealth tax, and I think it's fair to say, I don't know what you guys agree, I just don't think it's workable for a number of reasons. You've got the valuation aspect of it. I don't think any other economy or developed economy has an inheritance tax and a wealth tax that's quite high in one. So that would be an absolute outlier. And if you actually look at the stats of wealth tax, the amount of money it would bring in, 80% of it would affect 5,000 people, 5,000 people, and 15% of it would affect 10 people. Now, that probably says a lot about the inequality in this country, which we could probably come on and talk about. But we are a very mobile society nowadays, and people can move abroad. And when you have wealth taxes that you're sort of portraying, that 10 people could move abroad and it could make a significant decrease in what you're looking to bring in, ultimately what you're going to end up is a property tax, which I'm sure we'll come on to.
Good old mansion tax.
Yeah, absolutely. We'll touch on that a little bit later. And I agree, wealth taxes are unworkable, but as an accountancy firm, I think we quite like one. It would be quite a nice thing for us to have to play around with. But it's a good thing they didn't bring it in. They work in.
LLPs as well. We did a lot of work on that before the budget as well, and the rumoured tax increases for those people involved in LLPs as well, which didn't come in, did it?
That's right. Yeah, there were rumours that they were going to introduce like an employer's national insurance charge on partners of partnerships, and that didn't arise, which is a really positive thing for all those who are still structured as LLPs or partnerships. So that was a welcome thing not to be in. But there were some things that are in there, and there were some things that have already been announced that are coming in April next year. And I think the one that we still see protests about is the agricultural business property relief situation. So it's certainly much more your world, because I work in central London. We don't have much agricultural
Yeah.
property in central London. So maybe between the two, if you can pick this up as to what the issue is, when it's coming in, and some of the things that people are looking at doing to work their way around it.
Yeah. Do you want to go in? Or?
Maybe I do the business
Yeah,
and you
yeah.
do the agricultural. So, and with all the bluster of the budget, it's sometimes you miss the things that they announced last year.
Right.
There was a lot of stuff that was announced this year that won't come in for a few years. So we're going to have to watch out with our timings, I guess, moving forward, and keep a diary a bit better for ourselves. But ultimately, this is, I think, one of the biggest changes in tax in a long time. And effectively what it means is, in the past, trading businesses, trading companies, agricultural businesses used to qualify for mostly 100% inheritance tax. So it doesn't matter how big or small your business is, 100% inheritance tax would apply. And that was usually pretty good for the economy, because you want these businesses to grow and move on and carry on. From April 26, the government are capping the inheritance tax relief. So you'll get £1 million inheritance tax free if you qualify, and then the rest will be at 20%. And the important thing in the budget was that we talked about this a lot, this £1 million allowance, and how most people have husbands and wives. And it was very annoying that you had to draft wills in a certain way to use the £1 million relief effectively. But they've been sensible, and they've done some changes so that you can just pass it over to your spouse without doing all those changes. So that's a really good thing. We've got to commend the government for doing that. But the biggest issue I have with this is, number one, valuations of the company. I don't know if anyone's done valuations, but they are hard. You're going to have a lot of people arguing with the revenue about these things. But it's also the tax impact on these small and medium-sized companies and their ability to invest in capital and grow. And I think it's best explained with an example where a lot of businesses are valued on a multiple of earnings before tax, earnings before depreciation. So if we have a business that does £1 million of that, usually it's between 5 to 10 times, maybe 5 to 12 times.
Give or take.
Its valuation, give or take. So that's a £10 million valuation. £1 million off, then 20%. Someone help me with the math. I think it's 1.8 million.
Give or take.
Give or take. What's that? That's 1-2 years profits.
Where are you going to find the money?
Where are you going to find the money? Is the business owner going to think, oh, for the next year, I'm going to invest loads, get employees, pay the payroll tax, double my business, double the VAT that the government has.
Take the risk.
Take the risk
Yeah.
to then pay a huge inheritance tax bill. It's a bit of a economic killer in my personal opinion. But we're doing an awful lot of work with clients to solve this problem.
So let's come on to the solutions in a minute, or the possible solutions. Kelly,
so from, I guess, more of an agricultural perspective, you know, I come from a generational family farm in Devon, so big topical issue for us. And some of my family were actually in Westminster on the day where they rallied outside as well. And I think this is a great change for them, you know, to see the £1 million be transferable. I think maybe it should have been like that from the beginning. You know, we've obviously got the nil rate ban, the 325 that can be transferred, and also the residential nil rate ban. And it did seem strange when it was introduced that it also wasn't going to be that way. And especially kind of in farming and agriculture, quite often, you know, it could be, the farm could be run by husband and wife, but, you know, husband probably is the sole kind of owner of that business. And we saw, you know, lots of people actually changing the ownership for that £1 million retaining. So it is a good change, but I still don't think it goes far enough to help the industry. You know, speaking from personal experience, these are individuals that make our foods, supports British farming as well. And you can quite easily get up to that 1 million, kind of a different valuation method than what Ian was saying. But, you know, the machinery to be able to actually farm, you know, a tractor's around 100,000. You know, you need 4 or 5 of them to even think about running a profitable farm. And then land as well. So, you know, they are quite asset rich, but they just don't make, the profit to kind of merit that. And then when you think that they're doing this all for their family and children, and now they're going to potentially be suffering IHT, it just doesn't sit very well in that industry.
I think it's very fair to say that it's very hard to make a profit on a farm with less than 200 acres, maybe a bit more.
Yeah.
And what are we
Definitely.
talking, 12 grand an acre now?
Yeah, 10, 12 grand an acre would be, So it's not enough to protect, because again, where is the money to pay that inheritance tax bill going to come from?
Because not everyone is Jeremy Clark. Not everybody has an Amazon
no.
show
Yeah.
that follows them
Yeah.
around their farming journey.
And I think in some ways, actually, that, everyone loves Clarkson Farm is amazing. But in some ways, that kind of spotlighted that, because he was very, proactive in saying he wouldn't have to pay any inheritance tax because he was farming. And in some ways, I think that actually might not have.
It's been a thing they've been trying to look at attacking for a long time. I did also notice there's an anti-avoidance provision on farming that's been brought in. So if you own your farm through an offshore structure, it's been brought with inside inheritance tax, despite the fact that it would otherwise have escaped alongside all other kind of commercial enterprises. But I don't think it's both of them to one, but they're saying it's about 500 million, right, that they're going to raise on an annual basis from this. And that to me isn't enough money. And that to me just simply is too lower an amount of cash to raise on something that affects so many people. And for me, and I grew up in a farming community, not a farmer myself, but like it seems to be you're sort of hurting the wrong people with this kind of policy.
And I think before the budget as well, they were talking about, if it is a family farm, you might potentially be protected, and they were going to bring in tests to see if,
Right.
But that didn't come in. So I think, in that industry, they have found it disappointing.
Yeah, I know. And so, I mean, we don't know exactly what is going to be in it because it's not March yet. And I think it's important. One of the takeaways from this budget is that there's like another shoe to drop maybe, and maybe next March in the lead up to the new tax year, there might be some more goodies or baddies thrown into the mix. But what planning opportunities have we got in order to sort of navigate these changes?
Well, ultimately, it tends to boil down to about three things, really. Number one, bring your children in, bring your other family members in, look at gifting, farmland, gifting
trading businesses, aren't they?
Trading businesses can still gift tax-free with really good planning. But you got to trust your children. You got to trust your family members. And it's not just trusting them per se. It's all sorts of things that can come out of the wash. Bankruptcy, spouses, divorce. We talk about these all with our clients, don't we? But that can be a really good way to maximise the £1 million allowance. I mean, I know a farmer that I've been working with, and he split it 12 ways to get his £1 million allowance. That's going to be an interestingly run farm in the future when they're gone, I suppose. But equally, if you want the added protection, look at trusts.
Right.
Look at trusts. Look at the way you can set up maybe a discretionary trust where you could be the trustee, for example, and keep control of it, but your children can benefit from that. And it moves into a completely different regime, because then you have, instead of inheritance tax every time someone dies, you have a 10-year inheritance tax charge, effectively, which is usually 6%, but we think will be 3% in the future with the 50% relief. And it can be quite good because you can plan for it a bit better. Every 10 years you can plan for it, but you still need the cash, Tom.
And you do, and also there's a window. So in order to do this tax efficiently, you've got until April, end of March really next year. That's the window.
I think it's definitely making everyone think about succession, isn't it? And they should come and kind of speak to us, because previously these allowances being uncapped probably meant that people didn't take advice because they didn't pay inheritance tax, and they could get away with it without taking such professional advice. Whereas now, definitely come take advice. There are definitely things we can do to help.
Quite right. I mean, the succession point is really important. What you've described there is succession. It's how are you going to pass on your business to those that are around you. And it doesn't necessarily have to be your children. It just so happens that it's usually the most tax efficient way of doing things. But you can set it up in a different way. And we're going to come on and talk about things like employee ownership trusts and other stuff as we go through. I think you mentioned three things. Would you just touch on two? Or was there?
Well, the third thing I've been speaking to with my clients is sell it. If you think it's a good business and you think you're going to be hit with an inheritance tax bill, sell the thing. Sell the thing and create some cash that you can gift to children, get some value out of it. Or equally, I mean, we've talked about this in the past, Tom and Kelly, set up a holding company and create a FIC in the future, family investment company. So I'm used to this jargon, so I go on with it all the time.
Marketing speak there.
Marketing speak. But what we do a lot with clients is, I'm a big advocate of setting up a holding company for almost all trading companies. So there's so much power in it in terms of asset protection, but one of the main benefits of it is you can sell your business tax-free, or at least give you the opportunity to sell it tax-free. And that's due to substantial shareholders exemption, where if you sell a subsidiary that's trading, you sell it tax-free. The cash goes up into the holding company, you think, oh no, I haven't got the money yet, it's in the holding company. If you don't need the money, you can arrange the shareholdings so it's split between the family probably before the transaction.
Yeah.
And it works as a wonderful family investment company that could support your family for generations and generations. It's very tax efficient. You do a lot of fixed.
Well, I do a lot of fixed, and I think they're a wonderful thing. And we'll share with our webinar a bit of a sort of infographic about what a FIC is and how it works, particularly for inheritance tax purposes. But getting the cash in, that is one way of doing it. And I agree with you. The ability to benefit from SSE is a substantial shareholding exemption is a real thing. So there were some nasties in this particular budget. There weren't a lot of good things, but there are some good things, which we'll come on to. But whether you believe this was a manifesto busting moment or not, there was an income tax rise on property, on dividends, and on investment income, so interest. So Kelly, do you want to touch on that?
So interestingly, so all of those kind of things Tom mentioned went up by 2 percentage points, aside from the additional dividends rate. I don't know if you guys have any thoughts as to why that didn't go up as well.
Well, I did have one thought. I always thought that the higher rate and the additional rate were about right, because the idea was to mirror it with employment tax. They're about okay. I always thought the basic rate was a bit too low, because if you do the calculations, a bit too low. Why they chose to do the basic and the high rate and not the additional rate, your guess is.
I mean, it doesn't seem logical to me, but anyway, so exactly that. We've got the property tax as well, so that's gone up by 2 percentage points for each band, and that is a brand new tax as well. So I don't know if any of kind of tax trainees are used to writing out their 3 columns and taxing. There will now be 4 columns in your tax computation. And I guess 12 different tax rates to remember. So yeah, our jobs are getting a bit more difficult with remembering all the rates, but luckily we have very good software. But yeah, so we did see that. We didn't see any kind of before the budget, it was being rumoured there would be actual rises to the income tax rates. We didn't see that, but we did see threshold freezes again, didn't we?
That's right.
And like the personal allowance now, I don't think it's gone up since 21, is it? So,
that's right.
And now it's committed to remain frozen until 2031. And also the basic rate and higher rate bands of income tax as well. So, I think if the personal allowance was going up with inflation, etc., it would be about £18,000 now, and we're still at 12,570. So I don't know, you can decide for yourself whether she kept to her manifesto and didn't raise taxes for working people. But, I'm sure everyone's heard the term fiscal drag, but it's definitely taking effect. Yeah. And I guess the property, kind of investment income as well does more lend itself to potentially these things are potentially better in a company.
Yes.
So family investment company, which we've already spoken about, good home for these type of returns. Companies pay tax at 25%, broadly speaking, and an individual can pay tax at 45 on these types of income, 47 going up to now with interest. There's a big difference. That it does seem like a sensible move, and there's not much in the legislation that can sort of unwind that for your benefit. So it's worth considering. If you have if you live off investment returns and an extra 2% is going to hurt you cash flow wise, then it's worthwhile considering family investment companies again if you've done so already.
And the interest relief.
Well, the interest relief is an absolute nightmare. It's been around for a long time now. Anyone who's involved in property, renting property out, knows that they don't get full interest deductions if they're a higher or additional rate taxpayer. So that's a 40% or 45% taxpayer, and it can be really damaging. But with a company, that restriction doesn't kick in until your interest is 2 million quid a year. And that's a fairly large property business, and you're probably already talking to someone like us at that point. So that the other thing that came in, which sort of, it was one of the only things they announced as a kite, I think you called them before, that actually seems to have come in or was going to come in, or they're consulting about maybe coming in, as the government tends to do these days, is the taxes on electric vehicles and plug-in hybrids. So the basic plan seems to be that as more people adopt EVs and FEVs, plug-in hybrids, then our fuel duty revenues fall, because people aren't filling their cars up with as much fuel.
But interestingly, they keep freezing the cut to fuel duty,
which
doesn't make sense.
It doesn't make any sense. But they're unfreezing it from September, which is nice. So there is an actual hole that's been built over time based on policy to drive people into EVs and FEVs going forward. So they've decided that they will try and bridge that gap by introducing a per mile scheme. Now, they have promised not to ask anybody driving these cars to put a black box in their car to tell them where they are, what they're doing at any given time. for privacy reasons, which is a positive thing. But instead, every year, the plan is that you will take a picture of your odometer in your car and you'll stick it up on a government website and you'll pay a price based on how many miles you've done. 3p for an EV per mile and 1.5 for a fare. How are they going to deal with some of these things? How are they going to deal with people who like drive overseas or?
Yeah. Oh, apparently that's included. If you drive overseas, apparently
it's
that's
included.
Yeah.
It's just part of the thing. So all this good stuff has been thrown in there, and you do a quick bit of math. You think to yourself, well, I drive a plug-in hybrid. I do 20,000 miles a year, so it's going to cost you an extra 300 quid. That's quite a lot of admin to go through for 300 quid. So it seems like a strange thing to do when you could just stick some stuff on road tax.
Stick it on road tax.
Stick it on road tax. I think we'd all be upset because no one likes paying tax, but I think for some will win, some will lose, just like I do today. And I think that would be a more sensible solution. It is a slightly balmy idea because at the moment there are 2.8 million road users that use these cars.
Yeah.
I mean, the lack of compliance is going to be an issue. Who's going to police it?
Yeah.
So anyway, that was something else that was thrown into the budget. It doesn't come in like a lot of these measures. I think importantly, so when does the income tax rise come in for property?
I think it's 27.
So 27 on that?
I think dividends there was 26.
I don't think that's right. And I think that it's very difficult to remember all this stuff.
Yeah.
I think electric car charges is 28.
28, yeah.
Yeah.
And there's a couple of others that we'll talk about a little bit later, which is 2029.
Yeah.
I did find it quite fascinating because when you go through the budget, I think I worked out that it was about 0.7 or 1.2. I couldn't quite work out of the actual changes came in this year.
You're correct, yeah. I mean,
So it's all backloaded.
It's all backloaded. And one of the ones that wasn't backloaded, which came completely out of the blue, was the tax changes to employee ownership trusts. So which one of you wants to pick up on what they are, what they do, and what the change is?
Okay, let's explain what an employee ownership trust is to start with. So it's been in for a while, surprisingly. It started off with a little bit of traction, but we're getting about 1,000 of them a year, 1,000 companies going into employee ownership trusts a year now. And effectively what it is you set up a trust for the benefit of all your employees. That trust then buys the company off the selling shareholders, very simply. The benefit of that for the selling shareholders is they used to not pay any capital gains tax.
0%.
0% capital gains tax.
No cap, no thresholds. No.
Brilliant. I always thought that was too generous, by the way. If I'm going to give an opinion.
You weren't alone.
But there you go. Hence why they've probably changed it, losing too much money. But the key to this, and one of the reasons why, is because a lot of these employee ownership trusts, they do the deals so that the money comes out of the profits of the business over, say, I think the average is 7 years. So you're paying the old owners over 7 years. In theory, they're taking some risk in that. And you got the tax break to do it because everyone thinks employee ownership is a good thing. And it is a good thing if you get it right.
Yeah, agreed.
You get lots of great tax reliefs from employee ownership trusts. So this change that's come in shouldn't mean people shouldn't look at it. It's still a good thing. But the change itself is that instead of paying 0%, you're going to end up paying 12% capital gains tax in the current rate because it's a 50% reduction in the capital gains tax. I don't think that's so bad.
It's still the cheapest rate if you were to sell your business.
Yes, it is.
Isn't it? So
still the cheapest rate. There might be a bit of an issue with cash flow at the start, depending on how much profits or cash you have in the business to pay the old owners. But it's also a benefit to the employees, this, because with one taken away, one comes in full. So I don't think any of you have been involved in selling any OT.
Not yet.
No. COT. I have, and it's absolutely excruciating for tax purposes. So because it's 0% when you go in, the deemed capital gains tax base cost for the EOT is £100, zero, £1, whatever you want to call it. So when you actually sell the company, you end up paying, well, 24%.
All the tax gets paid by the EOT.
Paid by the EOT. And then you have 76% left. And then that is subject to POE on the employees itself, which comes with income tax, national insurance, employers' national insurance. They end up with about 30 to 40p on the pound. Not great. From this new change, it means some of the benefit that used to go to the sellers will now go to the employees. And it swings and roundabouts. So I think that could be quite a good thing.
I think it's a positive thing. I think you're right. And there are knock-on effects, and it's also why we don't structure them quite as simply as you've outlined.
Absolutely.
We use different types of share classes and trusts and employee management incentive schemes and all these other kind of clever things that exist to mitigate that problem and to give benefit to the go forward teams as much benefit as we can, assuming it grows. But I think it's a good change. I was speaking to a client directly after the announcement, and they take exactly the same view. I think the three of us share, which is it's not as good as it was, but it's still a lot better, like you said, Kelly. Right, 12% is better than 24. It's not as good as 0, but then what is?
Yeah.
And it's one of the other things I think I've noticed, and it's not really a tax thing, it's how you fund it, is that there are more lenders in the marketplace now that lend money to the business to use to pay down the initial tranche or some of the initial tranches.
I was at a finance forum the other day, and an employee ownership trust specialist came in to present about it, which I thought was quite interesting. The day after the budget, maybe he knew something that we all didn't. But he said exactly the same thing. He said not only are there more lenders, but the rates aren't as bad as what people think in terms of lending.
If you're going through a succession planning with your business and you're looking at all of your options, an EOT is definitely on that list. They are very attractive. They're a little complicated. There's a bit of like learning to be done, but they are really attractive.
I always find the nuances in that it's complicated, but you don't have to deal with a seller where you're negotiating, arguing over a price in a contract. That becomes complicated as well. Hopefully, it's a nice, simple process.
You have a lot more control over the timeline. You have a lot more control over everything, and it's definitely worth looking at. So that's employee ownership trust, and it was completely out of the blue. I didn't hear anything about it in advance.
One of the only ones effective as of the budget day as well, wasn't it?
And that's the big surprise. So if you're midway through a transaction,
and they take a long time. Like, how many years on average would it take to?
Most of these transactions take from the first conversation to the times, the cash transfers, which is the day takes 6 to 9 months.
So even if we did hear the rumor a month before,
there would nothing we could have done. Right. So this is the April 29 change, which is possibly after the next general election, even if they go through the whole 5-year period, which they're supposed to. So salary sacrifice.
So we may or may not actually see this come in, given it is nearly 4 years away. Salary sacrifice, I think we actually, this one was a little bit foreseen, because I remember doing some comms for our website on this. This is essentially where, you have a salary from your employer and you agree to forgo some of that salary, and in return, your employer will take that kind of money that you're forgoing and put it into a pension fund for you. So tax efficient for both the employee, because the employee is not paying income tax or national insurance on this, and also for the employer, they also weren't paying national insurance on this. And actually, if the employer was being very generous, in some instances, they would pass on their national insurance saving to the employee, making it even better for the employee. Whereas now, from April 29, it's proposed that there is going to be a cap for £2,000, but this is just on the national insurance saving. So it isn't a cap to how much you could put in your pension. That still kind of is around the annual allowance, which is £60,000 a year. This is specifically the national insurance saving will be capped at £2,000. Interestingly, kind of the biggest cost will be, on the employer. Employees, if their income is over about 50,000, they pay national insurance at 2%. So it won't be a massive kind of increase in cost for them, but employers are paying up 15%. And when you think about kind of how many employees they have as well that are going to have
That's a big number. It's a massive number.
And it seems strange because, the government wants to, incentivize people to contribute to pensions and not rely on them or the state in later life.
I find that absolutely fascinating, because they're going for a campaign, the government, about, come on, save to your pension, do this all good. And on the other hand, but we're going to hit you with this. It's a real mixed message.
And I think that the plan is, when it comes in, to get an extra 5 billion in revenue from it. So it is quite a big one. Interestingly, I think for the year after, it was predicted like 2.7 billion, because they expect employers to actually switch over to relief at source schemes, mainly because just the difficulty in like administering it. What if an employee has multiple payrolls, multiple employments? This £2,000 is per employee.
They're going to have to iron out the detail of this, because what's stopping the higher earner going to their employer and just saying off the cuff, give me 100 grand and give me a massive employer pension contribution, as it was. It does the same thing without doing salary sacrifice.
Exactly. It's lots of time for employers to plan, and maybe they'll come up with that arrangement where they actually end up putting more pension contribution in and kind of stall salaries a little bit because of that. But a bit of a strange one.
It's a really complicated thing that hurts people who work in the private sector.
It's
very difficult to administer, doesn't raise an enormous amount of money. On a 1.15, 1.2 trillion, probably greater budget by the time we get to 29,
Yeah.
2 billion is not a lot of money. And it as you said, I agree. It's going to hurt them. I was
Yeah.
talking to a couple of people who are in their, luckily for them, in their 20s, and they were like, well, if this is going to happen, I think I'd rather just have the cash.
Yeah.
And at least, I'd take away the complexity and use that money
Yeah.
maybe to try and buy a house at some point in my
Yeah.
later life. And
Quite
I
right.
do still see some value to that. And that would be absolutely against what the government's trying to do.
Yeah.
So,
And the auto enrollment as well as there on pension. So if you're on 40,000, the auto enrollment's usually you enrolled at 5%. It's going to affect anyone that is on a £40,000 salary and then above.
It's worth reminding everyone that salary sacrifice really has three elements to it. You've got the pensions, all very good. But let's not
Yeah.
forget, electric vehicles, I think still very good. Do you guys think very good?
Yeah.
Full capital allowances for the
from a capital
employer?
allowances,
Yeah.
so they're an excellent idea. Yeah.
Yes, not for the actual car. I know
No,
you don't like
not for me.
electric cars. And low benefit in kind, although that's increasing. The other one is cycle into work, bicycles.
No,
I
it's an
always
excellent
find that fascinating.
I live north of Swiss Cottage though, so if anybody's familiar with that part of London, cycling to work is not a thing you do more than once.
I'm going to generalize here, but I always see these cycle to work schemes used by really high-end bikes for middle-aged men that want to do Tour de France, maybe in the Surrey Hills. I know that's not what the salary sacrifice scheme was for. I mean, who would take a £4,000 built bike to the station to cycle to work? But the point of the matter is, I think that's still quite good, as with electric cars and with pensions at the moment.
I think it's a very positive thing, and I think when this comes in April 29.
Yeah.
That's 4 years. And there's an opportunity now for employers to look at their pension arrangements for their people, look at how they can maybe adapt to this going forward, but also to consider the other options that might be available to them that could provide a similar or even better benefit to their employees. Although salary sacrifice is a really, really good thing for everybody involved in it. And there's an opportunity now to maximise it.
Yeah.
Got
And I think if people do move more to relief at source, we so often see people not claiming, then there is an onus on you to do a tax return to claim additional pension relief. And the amount of times we've seen that missed. So maybe, it'll keep us even busier helping.
Another policy
people.
that gives us work to do.
Yeah.
Absolutely.
So keeping in line with money and cash, ISAs, not as bad as we feared, but still a bit of a hit. I can't remember. When does this come in? When are they changing this one? Is it 18, 17, 19?
I can't.
25?
27 or 28. I can't remember exactly when it's coming.
Get the right decade.
This is quite an interesting one. So the government are trying to encourage people to invest.
Yeah.
Not enough people invest in this country. So what they've decided to do is they've decided to cut the cash ISA allowance to £12,000, hopefully encouraging people to invest and not do that for over 65s because they think maybe it's a political disaster.
To do with a risk appetite, isn't it, or something?
That's a fair point, but I'd probably say if you're going to have that risk appetite, you should probably align it to the pension when you should draw it at 55 or 57 or so. But this all leads into where I see a budget is judged on. And a budget is judged on two things. Number one, I think simplification. Every budget, I hope for simplification. I know it doesn't create us a lot of money, but I want what's best for the economy and what's best for people. This doesn't simplify it. And the best way I can explain why it doesn't simplify it is because my wife called me afterwards, who I think she's quite a financially savvy person, especially because she has Mr. Tim moaning on about finance and money.
Well, she'll be pleased because she's probably watching.
She will be pleased. And she said to me, Ian, we can only put 12 grand into our stocks and shares ISA. What's going on with it? And it just made me think simpler is always better. But if it encourages some people to invest, I think it's got to be a good thing. The second thing I judge a budget on, not to go too far on this, is growth. I don't think this budget gave anything towards the growth of the economy. In fact, the OBR said in 2030 it would have a big fat zero impact on growth.
Let's not get into the OBR versus the Labour Party. There's enough going on about that today, I think. But yeah, I think the ISA thing is interesting. It's pleasing they've kept it at 20.
Yes.
I think that's good for people who save using ISAs and prefer those to, say, pension arrangements or whatever. The fact that they're pushing you into an £8,000 pot for stocks and shares and only 12 on cash, I mean, we'll see. And it's 27, I think it comes in.
I did see, interestingly, only 30% of people who have an ISA have a stocks and shares ISA. So, the appetite for that isn't there at the moment.
It's risk, isn't it? I mean, a lot of people, they see it as
Yeah.
cash, they don't see it
And
as...
it's also going to be, this isn't for us to worry about, but it'll be difficult to administer, because I heard financial advisors saying within your stocks and shares ISA, you can have cash as well. So how are they going to?
Yeah,
That's it. I was thinking
go
about
in and
that
out
the
of-
other day.
yeah.
I'll
Yeah.
just put all my money in my stocks and shares ISA in cash, and 2 years later I'll transfer it over to
Yeah,
a cash
so
ISA.
how can they?
nuances. And they'll
yeah,
figure it out, I'm
yeah.
sure. Hence why it's backloaded for a couple of years.
Yeah, well, that's right. And who knows if these things will come in. Student loans is next on the list, and Ian and I are too old to have one of these anymore. So
I'm glad you said that.
Yeah. I'd rather I was too young than still had one. But Kelly, as this does directly affect you, do you wanna-
this does directly affect me, unfortunately. They're basically freezing the level of income at which you have to start paying back your student loan. So it's going to be frozen at around about 29,000. And then any earnings above that, you would pay back 9%. Interestingly, like the day before the budget as well, we got told the national minimum wage was increasing. And they're actually predicting that if national minimum wage keeps increasing, whilst the student loan cap remains frozen, in a few years, you only have to be on minimum wage before you're
pay
paying
back.
back your student loan. Yet the whole policy is always kind of dressed up as, those that have gone to university and whatever, you're only going to be shouldering this burden if you have a graduate job that is well ahead of that. But soon it's going to kind of converge with the minimum wage, and 9% is a lot of money. And I don't even look at my statements anymore because the number on there is just not pretty, and it also is increasing by an astronomical interest percentage as well that does keep up with.
It's called capital depreciation, I think they called it, which is because they weren't allowed to, they didn't call it interest, at least when they sold it to me. It is a thing, and it's something that from a just working out in your head is the maths is quite. You have to spend a lot of money to start paying it back meaningfully. 9% is another bit of fiscal drag, isn't it? If you cap the stop threshold from rising, then you've got another bit of fiscal drag. This is not useful for a generation who are trying desperately to buy a house.
If it gives you any, it's just a graduate tax nowadays, really, isn't it? You don't think about the loan balance. And the
well, I can't
That's a
even look
positive
at
spin
it,
on
but-
that.
Oh, I know. I try my best
Financial
sometimes. Sorry, Kelly.
All right, and talking about buying a house, I mean the mansion tax. Someone's finally got their way, and they have put a tax in. Who would like to explain what it looks like, when it's going to come in, and who it's likely to affect?
Well, before I explain this, I should probably say how much it's going to make. And we all look at these sort of things as how much it's going to make. And we look at it as, most of the time we say, is it a rounding error? This isn't even a rounding error. If you look at the amount of money that's going to be made from this sort of thing. But effectively what it is if you own a very valuable house, and we'll come on to what we mean by valuable and whether we think it's valuable in the moment, £2 million or above, creeping up to £5 million or above and some tapering, you will pay an extra, I think the correct term was a council tax surcharge.
Yeah, that's right.
But realistically, it's a mansion tax because the councils don't get any of the money from it. So effectively, every year, you're going to be paying more if you have this valuable property.
It goes up to £7,500, I think, for ones that are over 5 million, which is a chunk of change. And the Chancellor's statement in the House, as there was announced, and she was bantering, I guess, with the other bench, was that if you've got a £5 million house, of course you can find £7,500 of cash every year in order to pay it, which it may well be true, but it's asset rich, cash poor for the second time today.
Quite right. But we did a bit of a bingo in the office the other day on this. And how many properties in London, or what was the worst property in London we could find that was valued at 2 million? And some of these properties, they would be owned by a postman 60, 70 years ago. And it's just sort of the way the property market is going. I'm not convinced a lot of these people are hugely wealthy.
Not everyone lives in South Kensington in a townhouse. I think that is right. It is also a tax that is aimed squarely at London and the southeast. There's something like 85-90% of the houses of the 100, they reckon there's 140,000. I think I saw some
in the whole country.
In the whole country, and 120,000, 130,000 are in the southeast and London, and which is a bit of an issue. And as you said, it's not a council tax. The money goes to central government, but the councils are there to collect it, so they have to go out and collect it. Interestingly, they're allowed to deduct from the money they collect the amount of money it costs to collect. So I wonder how
much.
100%.
Quite right. If I was a council and I was struggling for revenue, I think I would be thinking of clever ways to do that. And the other thing that comes reading through the paperwork is who values it. It's going to be valued by the district valuer. Now they've got a lot to do anyway, and anyone who has to deal with the district valuer, they are very, very busy people, and they're very good at what they do. And I disagree with them often, but they are still very good at what they do. But how are they going to find the time to value 150, 200,000 houses across the country?
Yeah.
Maybe Zoopla will come to the rescue.
I think it's strange as well, because if they are relying on kind of like equivalent property transactions and prices, kind of will we see like creating these cliff edges of anything above 2 million, you have a charge, but at 1.99, there's going to be no charge. So will we see kind of like price bunching and downward pressure?
Well, we will, because it's the old stamp duty thing when it used to be layered on stamp
exactly.
duty.
But then equally, if it is putting downward pressure and a 2.1 million house is going for 1.99, their take on stamp duty is less. So, the net position.
The SDLT being an egregious tax, but one that does collect a fair amount of revenue.
Yeah.
And this, as you say, isn't even a rounding.
I don't know why they couldn't have just bought it in at like you pay 0 and then up to 750 on like a sliding scale, rather than create like buckets that creates unnatural behaviour in a way.
Because it's easier to explain to people, I think.
Well,
Maybe
yeah,
that's
And
what
only
it is.
affects people who most people would say they don't have anything to complain about, I guess, as well. But it is a mansion tax. It's finally there's one that's turned up, and time will tell whether it comes in, and time will tell how it works, and time will also tell how it's going to affect the property market going forward.
Ian, you did an interesting calculation on the actual effect it could have on house prices.
Right, for anyone that knows me, I love my spreadsheets. So if my wife is listening, she'll love this. 2.5 to 3.5 million pounds. I tried to work out the discounted cash flow of the effect of this tax and how much it should come off house prices. And the calculation was about 150 to 250,000 pounds in that sort of price bracket. So that's theoretically what it's cost people. In reality, no one sells their house for less than they paid for it if they can.
No, quite right.
Go for that. So, that's just some of the work we do in the background, I guess.
Although the sort of the very, very expensive property market in central London has dramatically tailed off over the last few years. For most normal people, I agree. Right, so we've only got about sort of 10 minutes or so to go. Is there anything particular that we haven't spoken about that either of you would sort of raise?
I think EIS, VCT, EMI, that's
absolutely.
These are a couple of things. So EIS and VCT, these are when you invest in companies and you get tax relief for doing that. Some of the limits of what you can invest in companies, and specifically the companies themselves, are going up, which is really good for medium-sized growth businesses that couldn't access this.
Incredibly well used reliefs. Loads of people investing money into ideas. It's a great thing to see them increase the threshold.
And the second thing is EMI. You've mentioned it before. It's when employees get a stake in the game in your business, share options. They're so great because you don't have to give employees any cash or anything. You give them a piece of paper that says, if you sell in the future, you get a bit of money through it. And they're extremely tax efficient for the company and the employee, and the more companies are going to be able to do it because the rates are going to go up. And the tail end of what used to be a 10-year option can now be a 15-year option. And the important point to take away from that is, if you've already got EMI options in place, you can change the paperwork on your option to make them 15 years under the new rules. So if you have that, make sure you go and check your option agreements
and
update them.
And that limit's really important because it maintains the tax beneficial status of the option scheme, where you get capital gains tax treatment and not income tax treatment, which is there's still a big difference between those two. So this is all again about succession planning. If you're looking at handing on value to your people coming through the ranks, looking to run your business, EMI schemes and their sort of other approved option scheme friends, they are really attractive and are used all of the time. They're government designed. There's a process, the paperwork, of course, but they are very attractive. Kelly, anything in particular? I know student loans is definitely the big one on your thing.
Nothing massive, but there was kind of stuff in there about state pensioners. That's now going to exceed the personal allowance if you're just in receipt of the state pension. And Rachel Reeves has come out and said that she won't be collecting the tax if you're just over the personal allowance and your only income is state pension income. Winter fuel payments as well. That's now going to be means tested. So and HMRC powers as well. That was another one.
Yeah, HMRC's powers. They're quite rightly, we don't sell all schemes.
No, never have.
We advise clients based on their situations, and we're proud of the way in which we do that. But there are people that have been caught up in schemes, and there are still people out there who sell them. And so HMRC are beefing up their powers again. They do this quite regularly to aggressively attack and target people who sell these schemes around the world. Anybody involved in selling them. So if a third party is facilitating the transaction somehow, they're also going to be brought in within the mix. And I personally think I always like this kind of powers because these types of schemes that get sold around the place, they actually make our jobs much more difficult.
Yeah,
They do.
And it's hard to therefore advise clients to do the right thing when there's this other option, and they can sometimes see that it's too good to turn down. Ask Jimmy Carr how that works out. So yeah, that was a good one. Yeah, there are a number of. Our budget book is online. We've looked at most, if not all, of the the key points from the budget, and then those that aren't as key, but only affect a small number of people. It's definitely worth having a glance through. And if there's anything that jumps out, do shout and speak to either one of us or anybody else that you know well here at Gravita. I'm sure we'll be able to help explain it to you and make some sense of it, if any sense can be found. Final comments to you?
Final comments is, I suppose, one thing we haven't talked about very briefly, tax advisors, although are not getting a regulator, I mean, this is lovely for us, but it's important for some of the people on this video. We are going to have to register.
Yep.
We are going to have to uphold certain standards. And did you see what the definition of tax advisor was? Did you have a read of this? It is very wide. And I think unless they sort it out, it could affect people like conveyancing solicitors that submit stamp duty claims for clients. So,
that's going to be fun.
That is going to be fun.
What about a man down the pub? Is he going to have to register? Because a man down the pub's been giving tax advice for years.
Yeah, but that's the best tax advice going, isn't it?
Quite right.
Shouldn't
Absolutely.
have to
But
mandate
we'll
that.
just never register and just carry on.
And this is the thing about registration.
Yeah.
Kelly, any final things we haven't touched on?
No, I guess it, it wasn't the big kind of budget that we kind of thought it was going to be. But when you actually kind of look through, there are a lot of tax changes, just not necessarily really big, impactful ones or simple ones that are like a 1% increase. So, if you have any questions or anything, then please reach out, because it was quite a fiddly one, I'd probably call it, to kind of digest.
I think that's right. Yeah, I think that's absolutely right. There's a lot of measures within it that don't affect many people, but they do affect you, then you need to know about them.
Yeah.
So we'll reach out to you if we know that, but please do reach out if there's something that you notice or you're just unsure about. We're more than happy to chat it through. We've got a lot of responses to the poll. We'll reach out to everybody. I don't necessarily understand how to use the software, so that's always good. But we will reach out to you again with the Q&A. Thank you for all your questions. We'll come back to you individually and speak to you about all of them. And again, big thank you for the two of these guys, Ian and Kelly. Thank you for travelling into wet and windy London, although I suspect it's wet and windy where you came from as well. And thank you to all of you for turning up and listening to us ramble on about the budget that happened last week. Thank you very much. Enjoy your lunch breaks, and we will hopefully see a lot of you soon.
Thank you very much.
Thank you.
Bye.